We're joined by James Nixon, Chief European Economist at Societe Generale. James, let's start off by talking about the UK then. Christine Lagarde saying that it's a good idea to make the necessary cuts to bring the deficit down, but somewhat contradictory compared to what she was saying just a few weeks ago about prioritising growth over fiscal consolidation. Is the UK doing the right thing?
Well, that's an interesting question. I mean, it's a very different philosophy we're seeing on both sides of the Atlantic, with the United States obviously pushing the pro-stimulus growth agenda, and the sort of European orthodoxy, which you see both in Germany and the UK, very much emphasising the need to contain the deficit and get debt down. I don't know who's right at the moment. I mean, it'll be interesting to see who comes out of this on top in the end. Austerity
hasn't yet really bitten in the UK, has it? Just how painful is it going to be, and when are we going to feel it?
Well, it's certainly starting. I mean, growth is obviously, we've seen a number of measures kick in from April, and that's beginning to impact. But that's absolutely right. Some of the cumulative cuts in, particularly in employment, for example, for the public sector, those will only build up over the years ahead, as will some of the, cuts on things like child benefit. These will accumulate in the years ahead. So the austerity, I mean, it's coming, but it will start to bite probably in the next year.
And so you pointed out that the US is going in one direction with increasing focus on growth and the possibility of further stimulus, but still an emphasis on deficit cutting here in Europe. How is this divergence going to play out going forward? Are we going to see Europe actually shift in direction, if you like?
I don't think so. I mean, I think the European view is fairly well entrenched. There is a sense, it probably reflects the different political structure in Europe, that what we really need is some deep-seated structural reform to get growth moving, and that just relying on more fiscal stimulus that's not particularly well focused and not directed is not the appropriate response for the particular situation that we face in Europe.
But did we not get a slight change in tone from Jean-Claude Trichet? He seems to have gone from a more conservative stance to perhaps something a little more neutral. The expectation is that he may even reverse his policy on rates, start cutting rates if conditions get worse.
I think there certainly was, quite a remarkable U-turn, given that, only 4 weeks ago, basically, the ECB still had a tightening bias, and that was, commensurately ditched yesterday and, without any ceremony. Having said that, I mean, I still think, we believe the ECB, senses that, in terms of the particular problems they face, it is not interest rates that are the appropriate policy response. It's unlimited liquidity for the banking sector, the purchases of sovereign bonds for the individual countries that are in trouble, and those policy responses are much more appropriate to the actual problems Europe faces.
Speaking about extra liquidity for the banks, is ECB policy right now sufficient enough? Because it seems that concerns are mounting. We're seeing it in the markets, with interbank lending rates, that the funding market is getting tighter.
It is getting tighter, but we're not back at sort of Lehman levels. I mean, I think the two surprises really from yesterday are potentially that the ECB missed an opportunity to, say, reintroduce a new 12-month tender and really sort of kick this liquidity question out of touch. And then the other issue that we're hearing in the market is a lot of the European banks are actually struggling with their dollar funding. So again, there was maybe a slight missed opportunity to reduce the interest rate that the Fed and the ECB charge on that dollar funding in the United States.
But do you think comments from the likes of Joseph Ackerman about essentially drawing parallels with 2008, a post-Lehman style credit crunch, are exaggerating the situation?
I think at this stage, yes. I mean, it kind of depends what happens next. I mean, there are clearly some very significant risks out there. If we were to face a sovereign default in Europe that were to spiral and take down 2 or 3 other countries and then drag Italy into it, I think that would be a situation that would be comparable to what happened after Lehman. Well, but we're not there yet.
No, we're not there yet. But I mean, speaking of that, we are getting rising concerns about the possibility of a Greek default on the markets.
I mean, I think this is to a certain extent almost self-fulfilling prophecy. I mean, the most unhelpful aspect of the Greek bailout package is this process whereby each quarter we seem to have this review of how they're doing, and then this sort of tough negotiation to see if we actually will have the next tranche of money. And that dynamic in particular is not good for confidence. But but at the end of the day, I mean, Greece has made enormous strides, and I think that has to be respected and applauded.
Not being reflected in the markets, though.
No, because the problem is not going away. You look at Greece and you still think that it has an enormous challenge to rein in its deficit, and people are focusing, for example, on what happens, not only, even if Greece is successful, in another 2 years' time or 3 years' time, they'll need another bailout package. And I think that's a particular
focus. So what should they do, default and be done with it? What about the risk of a disorderly restructuring or an all-out uncontrollable default. Is that still there? Because we don't hear about that anymore. Has that concern dissipated?
I mean, it's the problem here is I'll end up sounding like an ECB spokesman.
Okay.
I think it's easy to say that we should have a default and once and for all and clear the problem. But I think the reality of the situation is that that's something that you really don't want to contemplate. I find it very hard to see how you can realistically do that without taking down the entire Greek banking sector and then creating serious contagion risks for countries like Portugal and Ireland. And that is a scenario that I think you really don't want to contemplate. Now, from the alternative to that, frankly, for the Europeans, is to actually accept the fact that they probably are going to have to finance all of these three countries, for a considerable period of time until this crisis is put to bed.
And you said much depends on what happens going forward. To what extent can the group of industrialized nations, the G7 meeting today, to what extent can they take action to, affect the broad direction of the global economy? Are we likely to get any kind of coordination from them?
Well, in many ways, the global economy is at a pivotal point at the moment. Growth is basically slowing. We face a situation where there's almost a sort of a zero-sum game, and everybody wants their own slice of the cake. So what we're really looking for from the G7 is to somehow, not let this get out of control. I mean, there's been quite a sharp response, I think, both to the Japanese intervention earlier in the year and obviously to the S&P's decision. And what we don't want to see is that kind of competitive depreciation or that kind of currency war sort of burgeoning out. I mean, Canada has voiced some concern, and I think the G7 will be putting a pressure on, for example, Japan to only take intervention that is, to a certain extent, multilaterally agreed. So what we don't want to see is basically the global economy descend into a situation where everybody is squabbling for their fair share.
How serious a risk is that? Because at the end of the day, what can the G7 do to prevent a central bank like that of Switzerland's from unilaterally intervening in the market to protect their own economy, their own exporters? What can the G7 do?
I think there's a certain amount of sympathy for the Swiss case. I mean, as a safe haven currency, they obviously have seen a very significant depreciation. I think what we don't want to see is, that kind of action sort of creating a sort of a domino effect. I mean, we have, for example, I think in one of the significant developments, we've seen China this morning, both some disquiet at the fact that the US is undertaking more stimulus and potentially, threatening its status as a reserve currency. So there's a very delicate balance to be struck in the global economy, not just in the G7 but at the G20, to not go down the sort of trade wars and currency wars route at this stage.
Seems those concerns are starting to resurface a bit, doesn't it? Thanks very much indeed, James Nixon, Chief European Economist, Societe Generale.